Hello and welcome to the part 2 of the case study on corporate valuation. In the previous part 1 we discussed about getting the data, raw data from the case study, copy pasting it here and make sure that you have 2013 to 2017 in this order, and then link this to the income statement, the balance sheet and the cash flow statement. Now the next step which we'll be carrying out is preparing the different supporting schedules. The first one we'll be discussing is the working capital schedule. Working capital schedule is prepared based on the current assets and current liabilities. For simplicity purpose, the case study talks about only two current assets, that is accounts receivable, inventory, and you have current liabilities as just accounts payable. So just link this accounts receivable to the balance sheet accounts receivable. Okay, then you have inventory also to be linked to the balance sheet inventory, and then you have accounts payable under the liabilities. Okay, so the net working capital is simply equal to all the current assets add, that is accounts receivable plus inventory, minus your current liabilities. We have just the accounts payable, so subtract it. So you have net working capital. Now we need to compute the change in net working capital. So the change is nothing but the previous figure, the current minus the previous year. So since the case study starts from year 2013, since we don't have anything, we treat it as equal to 0, let's say. So you have current minus the previous year. So this total change in net working capital should be matching with the cash flow change in working capital. So it is matched to the 9003. So that means this is working properly. So simply we can copy for the all the actual years by Control R, and then cross verify whether all this total matches with the changes in net working capital given in the cash flow. So is equal to this minus the cash flow change in net working capital. So you should get all this as zeros. So it's all zeros, so that means it matches. Okay, now let's develop the depreciation schedule. PPE opening plus capex less depreciation, PPE closing. So let's link this to the PPE opening. Since we don't have the previous year, so we cannot link the PPE opening, but we have capex given in the cash flow, that is investments in property and equipment. So you can link this to capex in the cash flow statement, investments in equipment, that is capital expenditure. Capex means capital expenditure. Depreciation is also given in cash flow, so we can link this to the cash flow, depreciation and amortization. Okay, the closing is simply opening balance of the depreciation plus capex less the current year's depreciation will give me the PPE closing. So that is given in the balance sheet. So if you go to the balance sheet, the property and equipment is given as 45,500, but we got 4,500. So that means we need to get this through a formula. That is what we call it as the goal seek. So in order to get gold seek, we try to build, because the closing balance is, we know how much is the closing balance. The closing balance is 45,500. So we want 45,500 instead of minus 4,500. So this needs to be done by changing the PP opening. Okay. So in order to get goal seek, we have to press Alt A W G. See the goal seek. Alt A W G. Set this cell to value how much? 45,500. By changing the cell, PP opening, and then you say OK and see what happens. See, so we got 45,500. So the opening is 50,000. Okay, so this is hard coded. So change this to the blue color which we were using in the other things. Okay, so you can take the format cell of this and then change this here. Okay, all others are black because they are all formula. So the blue is the hard coded and the black color is all you say formulas in black and hard coded is in blue. Okay, now we can copy this here. The opening will be the previous year's closing. Okay, and all this are same. Control R, and let's check whether we are getting 42,350 in the balance sheet. 2014 balance sheet 42,350. So we are right. So the formulas are picking correctly, and we can copy for the other actual years. Control R. So the PP closing is done, that is the depreciation is over and it's picking up properly. Now let's go to the debt and interest schedule. Debt opening we don't have. Issuance and repayment we have. So issuance and repayment we can get it from the cash flow statement. Issuance and repayment of debt. Debt closing you can get it from cash flow or the balance sheet. No, from the balance sheet. Let's go to the balance sheet. Debt closing is 50,000. Okay, interest expense you can get it from cash flow or you can also get from income statement. Yeah, we take it from the interest, from the income statement. Interest. Okay, so the debt opening, because the debt closing is 50,000, so the debt opening naturally has to be 50,000. So 50,000 means I can copy from here the same thing. Okay, you have 50,000. Now we can take the debt opening as the previous year's closing, and then all this we can copy by Control R, and all we can copy here. Control R. So everything is working perfectly well. So now that the schedules are ready, we move on to doing the assumptions. So let's do the assumptions. In the assumptions, it is simply computing the calculation. So assumptions will give me a feeling of a drivers. Okay, so what derives the revenue growth, cost of goods sold? So which one is a driver for this business? We can get from the income statement assumptions and balance sheet assumptions. So revenue growth and all this, let's compute. So let's do the revenue growth now. Revenue growth, we treat it as percentage change. So since we don't have the previous year for 2013, we cannot compute this. Okay, but we start from 2014. So 2014 is equal to revenues. Go to the income statement. 2014 revenues, okay, divided by 2013 revenues minus 1. So you have the percentage. So change this to percentage. Okay, then cost of goods sold, we take it as percentage of revenue. Percentage of revenues of 2014. So is equal to COGS. COGS as percentage of revenues of 2014. Okay, we convert this also into percentage. Then the next is salaries and benefits as a percentage of revenue. So we assume that these are variable costs. So it's again also taken on percentage of revenues. So go to the income statement, salaries divided by revenues, and these are also percentages. Rent and overhead, these are given in dollar values, so we treat it as it is from the income statement. Just link it to the rent and overhead. Depreciation and amortization, you can use many methods. You can use it could be percentage of revenue, it could be percentage of PPE, or it could be in a detailed way by developing detailed schedules, right? So for our purpose, we take it as percentage of PPE. So depreciation is nothing but percentage of PPE. So you can take from cash flow PPE, balance sheet divided by okay, depreciation and amortization is percentage. So let's take depreciation and amortization from the income statement, okay, and divide this by balance sheet, property and equipment. So that becomes my percentage of PP&E. So I can take this as percentage. Interest is a percentage of debt. So go to the income statement, take interest as a percentage of debt. Okay, and tax rate also as a percentage of EBT. So let's do tax rate is equal to percentage of EBT. Tax is here divided by percentage of PBT, EBT, sorry. So we can copy all this here to 2013. Okay. So now we go to the balance sheet assumptions. accounts receivable days. Accounts receivable days we can compute using accounts receivable divided by revenues times 365. Okay, so let's do this. Is equal to accounts receivable, you can find it in the balance sheet, divided by revenues in the income statement multiply by 365. Okay, so this gives me 18 days. So accounts receivable is taking 18 days time. Okay, inventory we can use inventory divided by COGS times 365. Inventory divided by COGS from the income statement times 365. Okay, accounts payable, you can do the same. Accounts payable are this divided by COGS times 365. Okay, capital expenditures we can take as it is, capex. Debt issuance we can link to the cash flow again. And then equity issuance also linked to the cash flow. Okay, so once we have this, then we can copy for the next year, and then all this we can copy until 2017. So now we have the historical ratios, and using these ratios we can go for projecting or forecasting. Okay, so let's do the now that we have the assumptions in place, let's do the forecasting assumptions as per the case study. So we have the case study here, and the assumptions are given in terms of the management's future prospects. So it says revenue growth is, upon reviewing the company's financial performance, we expect our revenue to grow by 10% for the next 5 years. So let's take this into account. Revenues are growing 10% for the next 5 years. Okay, then what does the management say? Working capital, we forecast our accounts receivable days and accounts payable days to be 18 days and 37 days respectively for 2018 to 2022. That means for the next 5 years it is 18 for accounts receivable and 37 for accounts payable. 18 and 37. This is what we had historically. So let's copy this. Okay. We expect the number of days it takes to sell our inventory to be 80 days in 2018, 90 days in 2019, 100 days for the last 3 years. 80, 90, 100. Okay, 80, 90 and 100 for the last 3 years. Then go to the cost and we are facing increasing pressure from high raw material cost and torque pressure, which will impact our gross margin by raising the COGS to 42, 47, 50, 36 and 35 for respectively for 2018 to 2020. 42, 47, 50, 36, 35. So let's take the cost of goods sold as 42 So this is percentage, right? Percentage 42%. It was 47% and 50% and 36%, 35%. Okay. Okay. Labor costs and benefits will remain constant at 17% of revenue throughout, and rent and overhead expenses are expected to be flat at $15 million each year. So labor costs means salaries and benefits. It's going to be 17, and rent and overhead to be 15 million. So this is how much? 17 and 15. 17, 15. This is not percentage. You can copy this. Okay. Then the next is capital assets. We plan to purchase 15 million of PP&E every year, and we expect depreciation amount to be 35% of total PPE for the total opening. This is important, so we need to, so they are changing the policy. Maybe 15 million PPE so this is 15 million. $15 million every year, and then depreciation was 35%. Depreciation is how much? 35%. So instead of average, it is 35%. So we can put a note if we want here. This is opening balance. Opening PP and E. Okay. For the next 5 years, so we can take all this here. Then we are left with debt and interest. We have scheduled to repay 20 million in term of debt in 2020. We will have an interest expense of 10% of total term debt for the next 5 years. So repayment is 20 million in 2020. So repayment is minus 20 million. And all our others to be assumed to be 0. Okay. We have an interest expense of 10% for the next 5 years. Interest expense is 10%. 10%. So there is a change in policy, so we take this as average. Okay, put a note. This is average balance. Okay, so this one is opening and this is average. Interest is on the average balance of the opening and closing. Then tax rates are 20% for the coming 5 years. 20% for the coming 5 years. Sorry, 28. Okay, so other things are not given, so we assume that they are all zeros here. Okay, so now that we have the assumptions and the forecast ratios, then we can do the projections for the income statement, the balance sheet and the cash flow statement. So once we have our assumptions in place, we can build the income statement. Okay, so let's go for the income statement and then do the projections for this. But keep in mind that these projections are purely based on the case study management case. But whether they are right or wrong, we don't know. We need to go into details of it. So being financial modelers, our job is to give the management case, along with it the best case, that is what we call it as optimistic, pessimistic and most likely situation from our point of view. And that will be what we call it as the projections are like a pro forma income statement. So these pro forma income statement is purely based on the management assumptions. So the revenues, we have assumed that it is a percentage change. Okay, so since we have computed the growth rates of the revenues, so it will be something like the previous year plus 1 plus the growth rate. Previous year times 1 plus growth rate. That is, we are assuming the method of forecasting as year over year growth rate method. There are so many ways of projecting, but we resort year on year growth method. So this equals to the previous year revenues times 1 plus the growth rate in the assumptions. 2018 growth rate is 10%, and then enter. And this you can copy for the other years. Then coming to the COGS, what is the assumption saying about COGS? COGS is a percentage of revenue. So let's do that. So this is equal to this times the assumptions percentage, that is 42. Okay, what I suggest is you copy all the formulas because they are all linked. Okay, so this we can control R, so we have the gross profit intact. Now let's do the salaries and benefits. So what does the assumption say about salaries and benefits? Salaries and benefits are also percentage of revenue. So let's take this is equal to revenue times the percentage given in the assumptions. Percentage is how much it is? Salaries and benefits percentage is 17%. Rent and overhead. Rent and overhead is directly the dollar amount, so we just link to the assumptions. Rent and overhead is 15 million. Then depreciation and amortization, interest we cannot do now because we require the schedules. So after we develop the depreciation schedule and the interest schedule, then we will fill those things. You can leave it here, or we can do this one also. Taxes. How much is my taxes? Taxes are given in the assumptions as 28% of EBT. Okay, let's do that. Is equal to earnings before tax times the assumptions. Okay. Now that we have these figures, we can copy them to the right. Okay. So the income statement is done except for the depreciation and amortization plus the interest. We'll revisit this when we complete the schedules. Okay. Now let's move on to the balance sheet. So what is balance sheet? Okay, let's copy the formulas because they are going to be same. Okay, so let's start with the asset side. Cash is the balancing figure coming from the cash flow statement. We cannot do right away. So let's focus on the accounts receivable. So accounts receivable, the assumption tells me that accounts receivable days are 18. So based on this, we can work it out, the accounts receivable. So accounts receivable, I can simply say accounts receivable is equal to revenues of 2018, okay, multiply by your accounts receivable days in the assumptions. Accounts receivable days in the assumptions, make sure that you are choosing the 18 year and divide by 365. So we have the accounts receivable. Similarly, inventory. So we can do the inventory also the same way. Okay, now let's do the inventory. Inventory assumptions. Inventory days are given to you. So take these days. Here remember that in inventory days we have used COGS. Okay. So let's use COGS and work it out. So the formula will be is equal to COGS cost of goods sold times the inventory days in the assumptions okay divided by 365. So you get property and equipment, we have to do it later. Accounts payable is COGS times the accounts payable days in the assumptions divided by 365. Debt, we'll do it later once the schedule is done. Equity capital, we can simply take the previous year balance plus issuance can link it, or we'll do it later. Okay, we will link it anyhow, is equal to previous equity capital plus any issuance of equity. Okay, and then retained earnings are is equal to previous retained earnings plus net income minus dividends. Since we don't have dividends, this is a simple model, so we just say enter. Notice that we are getting an error because we haven't filled yet the debt and property equipment and the cash, which is the balancing figure coming from the cash flow statement. So with this intact, we can simply copy for the years, okay, and then revisit the balance sheet once we are done with the cash flow statement. So now let's do the cash flow statement. Income statement and balance sheet is mostly in place. We first move on to the supporting schedules before doing the cash flow statement. So let's do the working capital schedule. Since we have the accounts receivable, inventory, accounts payable and the balance sheet done, so I think if you simply copy the formulas, it should be working. Control R. Notice that there is an error here because we haven't filled the net working capital properly. Because the cash flow is not yet done, so we have this error. So the moment we put the cash flow, then we should not have this error. Let's come back to this. Then you have the depreciation schedule. Let's copy the formula. So it's not picking the capex and depreciation because this was linked to the cash flow statement, and since cash flow is not yet done, we will not be able to do. But since we have the management assumptions, we can link to the management assumptions. So let's do that. First delete this. It is linked to the management assumptions based on the case study. So is equal to capex. Capex is here. Okay. And then the next is depreciation. What is the assumptions talking about depreciation? Depreciation and amortization is the opening of PP&E. Okay, so let's do that. Is equal to opening times the assumption PPE. Where is PPE? Capital expenditures. Depreciation is 35%. Yes. So I think we can simply copy this get the other values. Now let's take up the debt and interest schedule. Again copying this. So these are coming from the balance sheet. Debt closing, but we have to link it to the so debt closing is not picking up. So what I suggest is change the formula is equal to debt opening plus or minus your issuance and repayment and then copy the formula. So now it's picking. Still the interest is not picking because we have linked it to the income statement, and so now that this is given it in the assumptions, so we link these two things to the assumptions, not in the cash flow statement and not in the income statement, because the management has given its assumptions in the case study. So let's do that. So the debt issuance and repayment has to be linked to the assumptions. Debt and issuance 2018 is 0, so let's link this. And interest in the assumptions, interest we said it is average balance multiplied by the interest rate. So let's do that, is equal to average of the opening comma closing multiplied by the interest rate in the assumptions. Okay, so then we can copy these two things. Okay, now it's picking minus 20,000, so 30 minus 20 is 10. Yeah, it works. So with this in place, now we can move on to the cash flow statement. So let's do the cash flow. If we copy all these formulas, so since this is there, it works. Okay, but this is not being picked. So we need to put and link this to the assumptions is equal to and then fill down to get the So the mistake is here because we have linked the cash flow statement by bringing the next year. So simply we need to change this zeros because the management assumption is silent on this, so we need to put zeros because that circular reference error is going to come otherwise. So now I think it should work. Okay, so now link this to the assumptions. Yeah, it works now. So let's copy this. Okay. So this, I think because we have put directly the figures, even these are coming same. So let's link this. It's a linking exercise. So let's link this from the beginning. Even this is not linked up. Okay. Okay, now just link this to the income statement is equal to net earnings in the income statement, net earnings for 2018. Then depreciation you can link to, say, depreciation schedule 2018, and the changes in working capital we can link to the working capital schedule, changes in net working capital. Okay, investments in property and equipment we can link to the capex in the depreciation schedule, and opening cash balance is simply the closing cash balance. Okay, so once we have this, we can copy and make our cash flow statement. So once the cash flow statement is completed, then we can revisit the income statement and balance sheet. So the income statement, we have left the depreciation amortization. Now simply link it to the depreciation and amortization schedule or in the cash flow. You can do both ways. Let's do it in the schedule, that is better. Depreciation and interest in the interest schedule. Okay, interest is 3000. So once this is done, we can simply copy to get our net income statement of income statement completed. Now we move on to the balance sheet. Cash is a balancing figure, we'll fill it later. Now property and equipment we can do now. This was not there. Okay, so property and equipment is equal to, you can get from the schedule or from the cash flow statement. So you can get it from the schedule. How much it is? And debt. Go to the closing debt. Okay, now we can copy this. So we have an error, so we can bring back the cash from the cash flow statement and see what happens. So you have the closing cash balance, and you see, boom, it gets tallied. Now if we copy right, the balance sheet has to get tallied and everything is okay. So that means the total assets are is equal to total liabilities plus owners equity. Okay, so once the three statement model is done, the next step is what we do is the valuation. Okay, so this I will show it in the next video. Till then, thank you. So try to do this as part of your case study assignment, and if you have any questions, please ask me. Take care and stay home, stay safe. Thank you.